Happy Friday. Matt McAleer, Cumberland Advisors, President, Director of Private Wealth with the one and only John Mousseau, known as the Moose, CEO, Director of Fixed Income. In terms of markets this week, a lot of action on the equity market for kind of a mild S&P close, but we'll shoot over to Moose first. He'll give us his thoughts, some ideas on what you saw in fixed income.
Sure. Just a couple of things. Thanks, Matt. Today, very good PCE number. Personal consumption expenditure, Fed's favorite measure of inflation, well-behaved 0.1 for June, year over year 2.5. It's definitely moving in the Fed's direction. We know Jay Powell's going to talk next week at the Fed meeting. Don't expect them to cut, but we expect the language to kind of be, he may be cutting in September. The market is certainly telling us that in the action in the last few days. So the 10-year bond is down to a 4.19. By the way, it was a 4.26 this morning. So it's gyrated around a little bit, but that was a good number. Muni market was maybe up a couple of ticks in yield this week because it's suffering from a little bit of extra supply, but nothing to really worry about. One thing that I think is important is that you and I have talked about often that the 10-year bond would be in a range, and even when it got 4 to 4.25, where it is now, even when it got outside that, we still thought that was the more natural range given where inflation was heading. We still think that, and when you see what happened this week with President Biden pulling out of the nomination, we see the polls start to narrow, and we see basically more credence given to the idea that you could have a mixed bag between the House, Senate, and the White House, divided government. I think the market's picked up on that a little bit, and that that has contained yields down rather than everybody being on the same side of Republican sweep or something, where suddenly you might think of unfettered spending and some inflation. So was probably good for bonds.
Yeah. It's that bracket we've been talking about, that range, and that's what we've been seeing. That grind in that 410 to 430 area. And it seems like when we've seen extremes, and we talk about extremes in multiple markets all the times, when we see that rip higher to 4.5, 460, you wanted to be a buyer.
Sure.
If we get a big rally from here, and keep in mind a rally in bonds means yields fall, would you consider at a 385, 390, 395 lightening up on some of your duration?
Yeah, if we got below 4, we would start to think about peeling back because we've been a little longer than benchmark duration. We're definitely longer going into the end of last year. Cut it back a little bit, but we're still longer. That's certainly helped in the last couple of months. So you would think about that. But you're totally right, and we saw this with the equity markets. When you get up above 4.5, they don't like it so much.
Yeah.
Down below 4.5, they start to get in motion a little bit.
And all asset classes affect one another.
Right.
Nothing trades in a vacuum. And John talking about the expectation of cuts and lower rates. You don't have to look any further than the small cap market. We talk about extremes, and that's why I mentioned it, John. 2.5 weeks ago, 3 weeks ago when we were on here on a Friday, spoke about the fact that the S&P was up at that time, let's call it 17% year to date, and the Russell 2000 was up 1%, right? A 16% spread in performance year to date. That was an extreme. We talked about the number of times it had happened the previous 30 years. Now, what do we have? S&P is going to close out the day right in the up 15% year to date. Where's the Russell 2000? Up 12.5% year to date. That 10, 11% narrowing or dissolving, dampening that extreme.
In a fast period of time.
2.5 weeks.
Yeah.
2.5 weeks. So and I'm fond of saying all extremes resolve themselves. Not all the way, all the time, but they resolve. You cannot live on an extreme. So we've had some nice push in some of our holdings that we had been really dragging on performance. Some of that small and mid cap where we had touched early there, obviously there was very little demand for it, but it goes to show how difficult it is to call a turn, right? If you weren't long some of small cap prior to 2 weeks ago. Right now, you're just playing catch up.
Right.
So we had to take a little pain to get a little lift here. By the way, as I said last week, as growth, as large cap and small cap have narrowed here, I'm interested in adding back to growth. And we did that in US ETF, just a small add to the S&P growth index, this ETF this week. Other than that, not too
Because it
much.
looks better on a comparison basis, right?
If you're going to get lower rates, I don't have any worries that growth can't continue to work, right? In terms of what we've seen is that Mag 7, that real growth area, probably got a little ahead of itself, has to take a breath, has to pause, has to consolidate some gains. And we'll see some more of this action next week. Because when you look at the S&P down, maybe 1% week during the week, week to date, last 5 days, that hides an awful lot of volatile action.
Up and down, yeah. Pick any day, and you're
if you miss
hundreds in one way or the other.
If you miss on the growth end right now, you're down 10% to start the morning.
Right.
So there's plenty of volatility. Volatility equals opportunity. We do have some cash available in strategies, and we're looking to spend that. So some of these names, some of these industries coming our way, and we'll keep on our toes in terms of rounding out our allocations. If you're having thoughts on how to allocate into a different interest rate environment, feel free to reach out. That's all I have this week, Moose.
Same here, bud.
Okay, enjoy the weekend. We'll be back next week after a whole nother loaded week of earnings.